Hey Vijay. Guys, can you hear me? Hey guys. Guys, can you hear me? Hey Naveen. Nice to see you here, man. How are you? What's up, bro?
What's up, man?
Ready to learn some options.
Yeah, a friend of mine is also joining now.
Oh, cool.
See, his name is Murtaza.
Hope his name is not Deepu.
No, Murtaza.
Okay. Yeah, 2 more minutes and we start. Absolutely on time.
I'm
How's
just
Dubai
trying to
doing?
log on. Dubai's all right, man. I just went out and I came back for a bit for some work.
Okay.
But I'm just logging in from my iPad because my battery is running out.
Yeah, cool. You know, Zoom has started this new thing. Each participant who comes in, I have to like click on admit.
Yeah. I know. I saw it yesterday. 831660831. You'll see me there.
Yeah.
Leaving from here.
Saw the markets today. Guys, whoever wants to talk, you can like unmute yourself and start the video or whatever and talk.
Umesh, what's up?
All right.
Yo, bro, what's up?
क्या फर्स्ट क्लास मार्केट तो आज
So,
बैंड बज गई थी ऑल बेयर्स वर लाइक स्क्रूड
why were you a bear?
नहीं आई वाजंट अ बेयर मेरा तो पुट बेचा हुआ था
Yeah.
so I'm making money on that put
I know.
and I have HDFC Bank I have Reliance so I'm okay with it.
Yeah. All the OTM puts in ISOL were all good today, man.
नहीं but it's scary पता नहीं किस तरफ जाएगा I'll just come back I'll just
Yeah. Deepu bhai,
Hey, what's up?
all good, man.
Sorry if I'm not in my suit or anything because I just got out of bed and
If you would have been in your suit, I would have to rush and wear a suit myself, man. Good, you're not in a suit.
I would have logged off.
So I've spread your message around to quite a few people. So if you do get a number of people who you don't know joining, then you'll don't be surprised.
Yeah, most people I wouldn't know. But this
Yeah.
clicking on edit each time is like, bhai, kaam kabhi karega? ये admit मतलब this is like a new rule.
For which
Hi,
one?
Arvind.
To click on?
Each time a participant comes in now, you have to click on admit. It's not like a auto admit. So
I think you can. There must be an option to change it in settings where you
So
could.
they changed the security.
Yeah,
I
but
can't-
maybe you can manually activate it now before you create the meeting as a meeting setting.
I checked.
Oh.
Nothing like that.
Oh.
Hi, Arvind. Cool. We can start. Let me share my screen. So guys, all of y'all can hear, right? Means
yep
Yes,
audio
yes.
problem.
clearly
So what we should cover today is like the basic of FNO, which is basically futures and options. The options is two types, call and put. So we'll go through these three. See now, all of them is constant. I'll have to like take a break to admit people in. I'm sorry about this.
I think you can change it in the
You can see my
settings.
screen, right? What?
You might have options. You might be able to modify the settings.
I can't seem to find it. For now, let's go with this. I'll figure this later. Thankfully, there's an admit all each time. So, anyways. So, regular cash market, everybody is aware of. Means there's a stock, and if you are owning the stock, if it goes up, you make money. If it goes down, you lose money. Now, this is how it was for a while until the financial market decided that there should be something called derivatives. And why are they called derivatives? Because they are derived from an underlying asset. So these contracts, these assets do not have any independent value unless there's a asset, on which it is based. So hence the word derivative. Futures is pretty simple. Basically, it is like a forward contract which is traded on the exchange, but it has a expiry date. So what we are saying in futures is basically that if the spot is 100 and there's a cost of carry, there's some interest element which gets added for the person who is owning that asset. So if you want to trade on that particular asset at the end of a certain period, add that of interest, and that would kind of become its futures price. And there are multiple such futures contracts for various expiry dates. So it's pretty easy because it kind of mimics how the cash market works. You know, if the price of the asset is going up, then even the futures would go up. If it is going down and you're owning the futures, you would lose money. So that's how the futures work. The complexity starts with options. This is where most people get confused and it's a little complicated. So we'll go through what it means. So call is defined as a contract which gives you a right to buy the asset at a certain price. Okay. So it's a right, not an obligation, and hence the word option. Similarly, a put is a contract which gives you a right to sell the asset at a certain price. Like I said, it is derivative, it is derived from an underlying. So whenever we are saying call of something, put of something, it has to have an underlying asset which it is referring to. Again, like with all the other derivatives, it has a expiry date. So one component of a call and a put is expiry date. And this price which we are referring to over here, this certain price at which we can buy the asset or sell the asset is called the strike. Okay. With these two, you basically come to define how this contract looks like. So let's say Nifty is an asset or Apple is an asset, and end of the month there are weekly contracts, there are
Umesh,
monthly
sorry,
contracts.
Umesh, one sec. I think just requesting everyone to put their mics on mute until and unless they have a comment, because otherwise there's too much interference in between.
Now, and let's see what the expiry date of this month's contract. So 30th April is, let's say, the expiry date. And now there are various strikes. So let's say Nifty as of today is closed at 8,792. Okay. So Nifty spot price is 8,792. Now we want to know how the call and the put chain looks like and what it would mean to own the call. So own the call or own the put. So you're basically either long the contract or short the contract. So these terminologies are also kind of jargon which one should be aware of. So if you're buying a contract, it would also be referred to as long that particular contract. And selling a contract would mean shorting that contract. Okay. If one is long a contract and you are selling this to neutralize your position, it is called buying and selling. Whereas if it is shorting the contract, then if you're neutralizing this position, it is called covering it. So these are the 4 terms which are kind of used. So now there are 4 like if we can put it in a table. So like I said, there are futures, there is calls, and there is put. And you could be either long or short of this. Now between these.
Umesh, we're unable to see your screen. None of us can see your screen.
Oh, is it? Okay. Let me share it again.
And Babu's trying to log on as well, but he's waiting for your approval, if you don't mind accepting.
Okay. Cool. Now everyone's in. You can see the screen now. You can.
Yeah, screen is visible now.
Okay, cool. So like I was
Screen
saying,
is visible. Yep.
if one is buying a contract, you could call you're long that contract. And if you're squaring that position off, you are selling it. If you're selling a contract first, it is called shorting it. And then once you're neutralizing that position, you call covering it. But finally, basically, it's buying or selling. And so basically, like I said, there's futures, there's calls and puts, and you can either go long or short on it. So between these 6 positions is how you can create pretty much all your option strategies. By futures, I also mean futures or cash, let's say, which is basically owning the asset directly. So between the 6, so no matter how complex or exotic a strategy name sounds, your condors, your spreads, your diagonal spreads, your, what have you, all of them are finally a combination of these, 6, a combination of these 6 positions. So now we'll go into how a call behaves, what it is comprising of, what a put behaves, what is a strike. So I'll share my screen to a option chain, and we can go through each of the strikes and see what it would mean. Okay, so I'll take Nifty only as an example. Let me share my screen of my web page. You share. Okay, this NSE web page is visible.
It is quite small though, but yeah. Can it be zoomed in a little bit? Yeah. Okay.
Now?
Yeah.
Cool. So this representation of all options in this manner is referred to as an option chain. I am on NSE website, and this is an option chain for Nifty, and the expiry date is 30th April. So like that, if we can change this to a weekly expiry as well. So we can see that an option, like I said, comprises a strike and an expiry date. With this two, and whether it is a call or a put, we have enough information of what that particular contract looks like. So we'll see that, on the left-hand side, all the prices mentioned are of calls. And on the right-hand side, all the prices mentioned are of puts. So this is how generally an option chain is distributed. The strike is mentioned right in the center. And on the left-hand side, we have the calls. And on the right-hand side, we have the puts. So like I very briefly, described what a call is. A call is a right to buy, a right but not an obligation. So what would it mean if I say that I have a call of Nifty 8,800, okay? And then what are these various components in these columns? We'll go through each one of them. But what does it mean? Like, why would I want to buy a call? So if I'm saying, if I'm buying a call and I have a right to buy that asset at a particular price, and that price is 8,800, means I want the price of the asset to go up, okay? So when would it make sense for me to exercise this particular call, or to means why would I buy a call and not a future? Means why are we even going into options? Why are we just not sticking to your regular buying of the underlying asset? The reason is that here, after paying this premium, if I am owning this particular call, this particular premium is the maximum loss I can have. So let's say the markets are extremely volatile and market rose up, let's say today by like 700 odd points. If tomorrow, let's say market goes down by 1,000 points, 2,000 points, it's doomsday. Even then, if I have a 8,800 call, my maximum loss can only be 474 rupees. So now I am going into a risk defined strategy where I am owning, my unlimited risk is over. I have limited risk of just 474. But if the market goes up, so let's say the market goes up till 9,000. So now I have a right to buy Nifty at 8,800 when on expiry, on 30th April, this particular contract gives me the right to buy Nifty at 8,800. Okay. So one would say that, all right, now the contract, the Nifty on, let's say 30th April is 9,000. So I made money, right? I bought it. I have a right to buy it at 8,800 and now Nifty is at 9,000. So actually I'm making 200. But no, you've actually paid 474 premium, and 200 is what you have earned between the current value of Nifty and the strike price. So 474 what you paid and 200 is what is left of that particular contract. 274 actually becomes your loss instead of profit. So this kind of brings us to what is the break-even point then of 8,800, means when would this contract actually make money? So 8,800, the strike plus the value of the premium which I have paid. So 8,800 plus 474. So 9,274 is my break-even point. If on 30th April, Nifty is above 9,274, then I would make money on this particular call which I have bought. Is this making sense? Means some feedback given this is my first such teaching experience would be great. Am I going too fast? Is this clear? Is this making sense? Guys?
So far, so good.
Okay, cool. So let's now go through the same exercise and understand why would somebody buy a put. So a call is a right to buy the asset at this particular price. A put is a right to sell this particular asset at this particular price, 8,800. So when would this this contract make money? This contract would make money, put would make money if Nifty goes down. So let's say on expiry, Nifty instead of 8,800 reaches actually 7,800. Because I have this contract, I have a right to sell Nifty at 8,800, whereas the market is only at 7,800. So I'm actually making 1,000 rupees on that. 1,000, it's in the money by 1,000 rupees. And I have only paid a premium of 391 over here. So the balance 609 rupees becomes my profit. So this is how basically, this is why one would buy calls or puts, because you want to enter into a contract which is risk defined, where where your profits are unlimited, but your losses are limited to the premium you have spent on the on buying the option. So one would think this makes too much sense, man. Why would not everybody do it? Means, it's limited loss and unlimited profit makes just perfect theoretical sense. So not everybody who buys options makes money, because these premiums kill the profits most of the time. So if you see, if just this is called. So yeah, let's go through the concept of moneyness. So all of this yellow part which you see, all of these strikes are called in the money. So these are in the money calls. On the right side puts, these are in the money puts. This over here, the white side on the put, these are
Can you explain what you mean by in the money?
Yeah.
Puts and calls?
Yes. Yeah. So this is out of money puts. This is out of money call. Now let's see what in the money is. In the money means that these particular strikes have a certain component of their premium which is of intrinsic value. Meaning what? So let's say if somebody is selling me, means if I am buying this particular contract, somebody is selling me, right? So somebody is selling me a right to buy Nifty at 8,200. Like, why would somebody allow me to buy something at 8,200 when the price today itself is 8,700? Makes no sense, right? But he would if this 8,200, the price of the contract has the intrinsic value, the value of Nifty as of today, already inbuilt within the premium. So let's say 8,200 is the contract is being sold at 885 rupees.
I'll interrupt you here. Now,
That
means, is the strike price lower than the spot or higher than the spot?
In calls, let's go only in calls.
Huh?
All the strikes which are lower than the spot are in the money.
Correct.
All
so
the strikes,
basically, if the strike price is of an call option is lower than the spot, it means it's in the money.
Absolutely.
Right? With respect to calls. Okay.
Absolutely. And all the strike prices which are above the spot are OTM, out of money.
Out of money.
Yeah.
In case of calls.
In case of calls. In case of puts is exactly the reverse. All the strikes which are above in case of puts are in the money, and which are below are out of money. So option prices as such comprises of two components: intrinsic value and time value. Okay. So one way to look at it is all the OTM options which you see are only time value because they don't have any intrinsic value. Let's say today was 30th April. Okay. This is when it expires. So, and Nifty closes at 8,792. If 8,792 Nifty closes, what is the value of buying it at 8,800? So this particular contract is going to become zero if on expiry day spot is at 8,792. All the contracts over and above 8,792 have zero value, right? Why would anybody want to buy, exercise a contract which allows them to buy an asset at a higher price than what is available in the marketplace? So all of these strikes will become zero on that particular day. Hence, all that which you see in white, they are all just time value. Okay. Here, these particular premiums are a mix of intrinsic value plus time value. So these premiums are a mix again of intrinsic value and time value. And there's an easy way to find out what the intrinsic value is. So 8,792 is my spot for, so 8,792. If I have to find the intrinsic value of the 8,200 call, all I have to do is 8,792 minus 8,200. That's 592. So this 8,200, 592 is my intrinsic value. So almost, let's say 600 rupees is the intrinsic value. The balance 285 rupees, which is added in this premium, then becomes the time value, or it's also called the extrinsic value. So it's intrinsic and extrinsic. extrinsic is equal to the time value. So is this concept making sense? Like these premium being comprised of the time value plus intrinsic value? This is confusing or making sense? Should I spend some more time on this, or any questions here?
This seems okay.
Cool.
Seems all right.
So
Yeah.
similarly, let's figure out the intrinsic value and the time value of the put side as well. So all the options, let's say, which are above the spot over here, these are in the money, and hence they will always have some intrinsic value. So if, let's say, you have bought a right to sell Nifty at 9,000 rupees, why would somebody give you a right to sell Nifty at 9,000 to them? You know, means it is, you know, you have a right to sell this at 9,000. So somebody has to buy it at 9,000. Why would that person just not buy it from the market at 8,792? Why is he ready to buy it from you at 9,000 rupees? Because you're giving him an extremely high premium. So this premium includes the intrinsic value. And again, it is very simple. 9,000 minus 8,792. So 208 rupees becomes the intrinsic value of this particular put contract. So 487 minus 200 odd, this 287 then becomes my time value for this particular put contract. So this is how you determine, you know, like what is the intrinsic and extrinsic value of any particular contract. You basically take the spot and you take the difference between the strike and the spot, and that becomes your intrinsic value. And these particular options, which are absolutely close to the spot, they are called ATM, at the money. So there are three concepts in moneyness. There is at the money, there is in the money, and there is out of money, OTM. Okay. Let's go through some other concepts which are shown in this column now. So these bid quantity, bid price, ask quantity. These are concepts which are applicable to even your cash market. So nothing new over here, but I'll still go through that. So bid is somebody is wanting to buy this. I'm bidding for it at this particular price. And this is the quantity, the last item on the exchange. Like somebody was wanting to buy this 75 is one contract, one lot of Nifty at 20 rupees. But somebody else was wanting to sell it at the ask price from someone was 21. So there's a gap over here. Somebody's ready to sell it at 21, but somebody wants to buy this at 20.35. So this is also called a spread. So, you know, to see whether an option contract is liquid or not, you have to see the bid price and ask price difference. So if you see, the closer you come to ATM, the, you know, they are generally more liquid, and you know, there's so much volatility that they're not seeming to be, you know, well matched. But generally the bid price and ask price, you know, the difference is, let's say, you know, 1 rupee 50 paisa or something like that in Nifty. Means they're generally that liquid. But the markets have been extremely volatile, and hence, you know, there's like a huge gap. So this is the concept for this bid quantity, bid price, ask quantity. Net change is the price change from yesterday. So this is what it is reflecting. Because the markets went up today by 708 points, hence this particular contract of call, let's say 8,700, rose by 334 rupees, whereas the put dropped by 448 rupees. So this is reflecting that net change of price in this particular contract from yesterday. LTP means last traded price. And this is what the contract was last traded at today on the exchange. And IV. So yeah, this is one super important concept of options. IV stands for implied volatility. Okay, volatility is actually in statistics one standard deviation. Now this is kind of like a detour. It requires some amount of statistics and this and that. Not much value going over there. I'll come to the theoretical definition of what IV means. So these option prices are taking into account uh, some future prediction of how the market would be. Okay, so they are expecting some kind of volatility. If I am certain, let's say there's no volatility and the market will only be at 8,700 over the next 10 days, let's say, then where is there a risk? Why would I buy or sell? Why would somebody buy this? Why would anybody buy a ATM, out of money call or a put? Means there's no risk, right? You're buying an option because you're expecting some movement. And that movement is actually what volatility comprises of. The more the movement, the more the volatility. These option prices are expecting some volatility, and based on that, they are pricing this option. That is why this volatility is called implied volatility, because it is so all of these option prices actually are calculated using a mathematical model. Model is actually a fancy term for a equation. And there are these three genius mathematicians, Black, Scholes, and Merton, who I think some 30 odd years back basically came up with this formula. Because investment bankers and over-the-counter, transactions, they were having a tough time in determining how to price options. So they came up with a formula of how a call should be priced and how a put should be priced, and in which this IV is one of the components. So you plug in this IV in that particular formula and it will throw up a option price. This is where the IV gets used. And because the markets are extremely volatile over the last 1 month, these IVs have shot up, means they went actually up to 80. Now from 80, they are back down to 50. We'll go through IVs further tomorrow or day after when we are going through option calculator and how it, affects the option prices. But just keep in mind that, IV is a very, very important concept, and it is majorly used even in Greeks. And there are major investment desks which do only vol trading. So this is also like kind of like a strategy. Then there is volume. Volume is basically the number of contracts which have got traded since this contract came into being. So this volume could have got generated even 4 months back. Doesn't matter. When this particular contract came into existence and it started to trade, each time one person has bought something, the volume has increased by 1. OI, on the other hand, is open interest. So let's say A buys from B. Here volume increases by 1 and open interest also increases by 1. Okay. Now A has bought from B. B has sold it. Now B, let's say, buys it and closes the contract at his end. And now the contract is now transferred to, let's say, C. So now the contract is between A and C. So the volume would still increase by 1 to 2, but the open interest would still remain the same at 1. So open interest is basically all the open contracts or contracts which are still yet to collapse. And generally, they keep peaking till expiry. On expiry, it obviously, collapses because all the contracts come to an end on expiry date. So that's what open interest means. So yeah, this is pretty much what an option chain looks like. If you even study this option chain deeply, you'll get to know a lot and understand a lot. And this is all where the action happens basically, and all the strategies which one would build, we would go through all the spreads and the diagonal vertical spreads and all of that, which we'll go through, let's say tomorrow or day after. They will all be built using these strikes. So we would buy some of these contracts, we would sell some of these in different quantities, and that's how we would make a strategy which would eventually make money for us. So yeah, so we've covered IV, we've covered what calls and puts are. What else should we cover today? Am I doing an okay job in explaining what calls and puts are? Because that was the aim for today, to give beginners an idea of what these option contracts are, why they are used. So let's cover. I covered the long side of it. If I'm buying,
It's still to a certain extent, Umesh, sorry, maybe I don't want to slow everyone down, but it still seems a little complex for beginner level.
okay,
I would have, maybe I'm just too slow on this, but I would have just basically thought
I'm
of it
getting
as, this graph is the Excel sheet or whatever the thing is in front of us is quite intimidating.
okay,
So
okay,
I think just the basic concept of what an option is, because for me,
okay.
as much as I know markets, just the whole option thing is still a little, it's a
Okay.
little confusing. So I think if we just break it down, like what you're doing on that paper is what seemed
Cool, cool.
more
So let,
engaging than that sheet. That sheet was like, till
I'm coming back to this sheet then.
yeah.
So calls, like I said, I'll go through this once again. I'll go through buying a call also and selling a call also. Okay. So let's say if I've bought a call, I am basically betting on the underlying going up, which means I am bullish. Okay. This so this would mean that calls premium go up when the spot goes up. Okay. Similarly, put, if I am buying a put, I am betting on the underlying going down. So I am bearish, and put premiums go up when spot goes down. This basic concept is clear.
Yeah.
Cool. So now let's see the exact opposite of it. Means if I am selling a call, if I'm shorting a call, what would happen? It would be exactly the opposite of me being long a call. So here, if I'm shorting a call, it would mean I am bearish, and I will make money when spot goes down. Hence, I am bearish. And here, I am bullish if I'm shorting a call, if I'm shorting a put. And I will make money if spot goes up. This also clear?
Yeah, just why would you choose to be long a call or short a put if they both are somewhat looking like the same thing?
Correct. So here I have, in long, I have paid premium, right? So my loss is limited. Profit is unlimited. So exactly the opposite of this. The guy who's selling me these calls has received the premium. So his profit will be limited to the extent of the premium received. But his loss will be unlimited. similarly, again, if I am buying a put, then I have paid premium. So my loss is limited. Profit is unlimited. And here I have received the premium. So profit is limited, again to the extent of premium, and loss is unlimited. Now you see, means even though these two are both bullish, so this is also bullish, this is also bullish, but this fundamentally changes everything. Means here my loss is limited and here my loss is unlimited. So that this one fundamental difference makes me choose between any of these options.
And in terms of your returns are capped in one of them. It's just that you get it upfront. So if you're trying to sell a put, then you are receiving a premium upfront, but that's all that you get.
Yes, that's all you will possibly ever get by shorting an option. You will never make more money than the premium received. Means that's how the game is. To short an option, again, because your maximum loss over here is to the extent of the premium paid, the margin expected by the exchange is equal to the premium. So if you're buying one contract of, let's say, which is like 100 rupees contract, and lot size is 75. So at 7,500 rupees, you are owning that call. Okay. Whereas the same thing, if I have to short, okay, if I have to short this particular call, now the exchange is saying that, your loss is unlimited. We don't know, how up the market can go. What if it goes up by 2,000 points? So your loss could be like 75 into 2,000. So we don't know that. So they basically take margin money. Somebody's chatting. Hold on. Okay, not funny. So the exchange basically takes margin money from you, and margins are generally 20% of the total underlying value. Let's say, for simplicity's sake. So let's say if Nifty Nifty is at let's say 8,000, okay, and 8,000 into 75, let's say around 7 lakhs. And 7 lakhs ka 20%, so 1.4 lakhs then becomes my margin money. So all retail users generally who don't have a lot of capital would rather spend 7,500 and be, in a peaceful position of, limited loss, unlimited profit kind of a setup, as compared to, giving 1.4 lakhs and then in fact earning lesser, just the premium. So this is another huge difference of, either shorting a put or buying a call in case you are bullish,
Is there a specific, you would say, a more favorable market condition where one would choose to short rather than long? I mean, where would you short a call or a put versus being long a call or a put? Like, why would you choose one or the other? Is there a certain scenario where you feel the market is at its peak or it's at the lower end, or what, which could probably make one decision maybe more favorable than the other?
Absolutely. So that it would all depend on these two items. One we already saw is IV, implied vol. The second is HV, which is historic.
Umesh, one minute.
Yeah.
Sorry, before you proceed, how is your loss unlimited in shorting a put?
Okay. In shorting a put, because if what is buying a put? You basically want the markets to go down. Okay. So somebody who has sold that put to you, he wants the price to be above that. Let's say I have taken from you a right to sell Nifty at 8,000. Okay. Okay. You have told me that, all right, if you give me 356 rupees on 30th April, I will buy Nifty from you at 8,700. I have bought the right to sell Nifty to you at 8,700. Okay. Now let's say the market reaches 6,000 that day for some reason. Okay. There are contracts which are as low as 6,100 also, which are trading for this current expiry. So let's say the market reaches 7,000. Okay. And you have bought it from me at 8,700. So you are sitting on a loss of 1,700 rupees. Whereas you've actually just made a premium of 356. So the balance 1,400 is lost, right?
Okay, get it.
Yeah. So that's how, if you're basically in a basic funda to remember, if you are shorting options, and they are naked options, like you have not protected them or hedged them or from any other strike. If you have any quantity of naked options, either on the call side or on the put side, you are not black swan protected. Your portfolio at one point or the other on a continuous basis, if you're doing it, will experience a lot of volatility or even bankruptcy. And shorting volatility is one of the most common strategies for large funds, and they have made tons of money and then they blow up. One classic example is LTCM, long-term capital management. It went from 1 billion in AUM, made huge profits over 4-5 years, went up to like $4 billion. And in fact, two of the people who developed this formula, Scholes and Black, they were part of that fund. They used to do only arbitrage, trading and pair trading, basically supposed to be extremely safe. But they were short wall, and within like a month, it basically got destroyed. So that's a topic for another day. But all in all, what I'm saying is shorting wall seems extremely lucrative, but it has got a lot of people in a lot of trouble. So we can cover that some other day in like detail. But yeah, like imagine, like what are the chances of 30th April, which is like now in 23 days, like Nifty falling by another like 25-30%, and that 6,100 contract is still fetching you 21 rupees. So it seems like free money, but it is not. Means, in fact, even I'm short this particular contract. But there is a risk. Means I'm aware of the risk, and if you're aware of the risk, then of course you can take a calculated risk and make money off it. But it's not like free money. So coming back to Deepu, coming back to your question of, are there any scenarios where shorting options or buying options is more preferable? So it all depends upon these two concepts: implied volatility and historical volatility or realized volatility. So like we determined that the option prices have a component in it in which they are predicting what kind of wall will happen over the coming few days. If the wall which actually gets realized is more than the implied wall, then long options would make money for you. On the other hand, if the realized wall is lesser than the implied wall, then you would be losing money if you are long options. In that case, then you should be shorting options. So now, because the IVs have risen by so much, let's say they went up to like 60, 70, 80%. Means it's a good time according to me to short vol. Of course, protected strategies, even though there are such wild movements of 600, 700 points, we can see over here. Let's say, what if you would have shorted both the call and the put? So here, let's say 8,700 strike you would have shorted yesterday. This would have gained by 334 rupees. So you would have, because you have shorted it at a much lesser price and this has gained in value, you would have lost 334 rupees over here. But you would have gained 448 rupees over here then on the put side. So net, this particular combination of call and put would have fetched you almost 110 rupees odd. Let's say one would say that, maybe, how would we know, that 8,700 is the strike which we have to short. So all of these are there. Means if on the other hand, it's at 8,700, if you would have shorted the 8,000 straddle. So this has gained by 524 and this has lost 266. So you would have basically lost almost 280 odd rupees or whatever. So here basically the volatility of this 8,000 straddle, the realized vol was greater than the implied vol, which was reflected in the premiums over here. So there's no sure short way as such. If one would just know that, what's the perfect time to, buy an option or sell an option, means there is nothing else you would require in terms of a strategy. That's like the holy grail actually. But theoretically, the concept is this, that the IVs which are reflecting in the premiums, if the actual realized vol is lesser, then you're better off shorting the option. If the realized vol is greater, then you're better off buying the option. Is this answering your question, Biku? Hello?
Hi, Umesh. Yes, sorry, it was just I replied on the chat that yes, it's quite makes it a little clearer now.
Okay. What all should I spend my time on today? Let's say 10-15 minutes. Basic idea of calls, puts, long, short, IVs, this all making sense. Tomorrow, of course, I've not gone through Greeks, I've not gone through option strategies. We'll go through that. We'll go through some statistics in the coming days. And we'll go through how to create an algo strategy, and we'll see we'll see an options calculator. We'll see how the Greeks affect the option prices. We'll go through all of that. But overall, what a call and a put is, and why they make sense as independent instruments to trade the market, and what are the benefits of longing and shorting. Both have their independent pros and cons. Means there's no one right, one right answer. Means people who are fans of shorting options, they protect it like religion. Because the probability of it is said that 80% of all options which are sold expire worthless, which basically means that all the premiums which have been collected by people who have sold these particular options become their profit. But then they are like, Nicholas Taleb and, a lot of other eminent people who give a lot of attention to risk management. They are absolutely averse to selling naked, options, and options which are like completely OTM, thinking that, this is like this much percentage away and this is like very safe and this will not be breached. All of that has been done, and it's no sense, doing those same mistakes again and again and testing it for yourself. OTM options will make you money 8 months out of 12. But that 1 month when it will get under pressure, it will result into margin calls, and it will result into you, closing that contract at a huge loss, which will take care of your which will destroy your profit, which you've earned from, all the balance 8 months. So there's a saying around this, that, it's basically like collecting pennies in front of a road roller, or eating like a pigeon and shitting like an elephant, or, things like that. That, it's not as safe or straightforward as it seems, that all right, let's just short a strangle. Let's say if my bet is like, Nifty is not going to go below 6,100, which is like 25-30% down, and in this expiry it will not go, let's say, about 10,000. So I'm getting 58 rupees over here, I'm getting 21 rupees over here. Let's just have these two contracts, earn my 70 rupees and be happy. Now, wherever Nifty closes between these 2 points, doesn't matter. You will eventually make the 70 bucks. Unless, now if it breaches 10,000, then your unlimited loss starts. So imagine if instead of 10,000, Nifty goes to 11,000. So now you made a loss of 1,000 rupees. 11,000 is what you will have to, settle the contract at, and you have agreed to sell. Means somebody is going to buy off you at 10,000 because he has bought a call at 58 rupees, and you thought selling it at 58 is a great idea. So he will buy it off you at 10,000, and he will sell it in the market at 11,000. Vice versa, you will have to purchase it at 11,000 to satisfy this contract. So you've actually made a loss of 1,000 over here, and actually you've received a premium of only 58 plus 20, 70. So you're making a loss of 900 over a maximum profit of 78 rupees. But of course, like in 20 days now, given these scenarios, the market rising by another 2,000 points is like a far-fetched thing. But I'm just saying that it's not risk-free, shorting options. So yeah, we went through longing and shorting calls, puts. What else should I cover? Give me some ideas, guys. Anybody can unmute themselves and like give me feedback. I'm new to this, so I'm.
When you say unlimited loss, it's very scary. So I think we can also put a stop loss for this unlimited loss, right?
Sure, absolutely. So this, it is at par then with you owning a futures contract to any other asset. So let's say, you have dealt in a quantity which you are comfortable holding, and which is not going to break your portfolio. Then it's fine. You can roll over the contract. At some point, you will, the market will either recover from your strike, or it will go down below your strike. So theoretically, as a concept, it's unlimited loss. But finally, it depends upon whether you're booking that loss or not, or whether it is breaking your portfolio or not. Certainly, you can, even if when the market is, even if the prices are rising and midway you are exiting from the contract, it is not unlimited. And in some sense, it said, in puts, the loss can't be unlimited. Let's say at max, Nifty can go to 0. So your maximum loss is capped at 6,000. On the upside, on the other hand, it is unlimited, because it can go not only to 16,000, but let's say 20,000 or 25,000 or whatever. It's a theoretical concept. I do get that. But to understand the extremes is good, for you to understand the framework within which you are operating. So, yeah.
So is buying a call option more profitable usually, or selling an option more profitable?
So from a probability of success point of view, it is certainly shorting an option. It means that is certain. But probability of success and the amount of profit you make are not synonymous. So let's say you have a probability of success of 1%, but the amount of winning is, let's say, 1 lakh rupees, and here the probability of success is 99%. Okay. But the amount you will win is, let's say, just 1 rupee, and you have, let's say, 100 chances. Like, what game will you play? So it is, it's called, what do you say, a payoff, probability payoff, or some such term is there, which basically you multiply the probability with the expected return. So from that point of view, there's no easy answer which one wins, because finally it's a zero-sum game. For everyone who's making money, there's a counterparty who's losing money. So given our general psyche, we want like a higher probability of success, and we feel that, all right, we are winning. And when a long options contract person actually is in that what do you say, in that streak of winning, he is going to book his profits much faster than maybe his losses. So all of these biases and cognitive biases come into play and all of that, but that's a different topic altogether. But all in all, there's no easy answer to what the total payoff is better in shorting options or in buying options. There's no easy answer. The probability of success certainly is more in shorting options, and exactly the counter, the probability of failure in buying options is much higher. Means that is also kind of like a certainty, but the amount of payoff which happens for that little times which you will win in buying options, that will take you to the next level. So now Bill Ackman of Pershing Square, he basically bought downside protection only last month, and he made almost like 1.2 billion odd dollars on his portfolio. So that is buying options. He basically bought a put, and of course he bought a CDO, but it is kind of like a put, let's say. So downside protection, your tail risk protection, is always buying options. Or let's say, what do you say, that The Big Short, the movie. So all of those contracts which that guy was holding on for 2 years, 3 years, they were buying options. So when the shit hit the fan and the mortgage market was crashing, those particular option contracts went through the roof. So they will give you returns then 300, 400 times. So, but you have to hold on till that particular point, and you need to have the ability to bear that much pain and let those premiums go month after month. So, yeah.
So, but do these large FIIs buy options also?
Absolutely. So as a mandate itself, the larger your portfolio, you have to have hedges. Means naked options is basically suicidal for a large portfolio. These retail players doing it is a different thing. Means the amount of money involved is much lesser, even if the portfolio blows up. But if you are managing people's funds, having no downside protection is more or less suicidal. So they have to buy options basically of what strikes, whether they are protecting it from inside or they are protecting it how many strikes away. That would depend upon the risk model and the strategy. But buying options, certainly.
Okay, thank you.
Guys, feel free, man. Ask me anything. This is better actually. I'm not like under pressure to talk about, one particular item, and it will help everyone.
Hi. This is Sandeep. Is it possible that if you can give any example for shorting option, any stock or any Nifty amount, which like today's rate, from there we can get any live example or some kind of thing, not live, but kind of numbers, which is currently in the market.
Sure. So this 8,700 call, if I want to sell this particular 8,700 call, okay, let's calculate what the payoff chart would look like. Okay, so 8,700 call of Nifty of 30th April expiry is available for, let's say, 500 rupees. Okay, let's calculate the break-even points. I'm shorting the option. You wanted to short it, right? So I'm shorting the call.
Yes, yes.
So this would mean what? If I am, like I said, let's go back to this particular thing. If I'm shorting a call, I am bearish. I want the market to go down. If the market is going up, I will lose money. Okay. At 8,700 on 30th April, let's consider three scenarios. Okay, let's create a table here again. Let's say market is at 8,700. It's at 8,000. It's at 9,500. Okay. Will this give you an idea of what it would look like?
Yes, yes, it is given.
Okay. So I have shorted this and I have earned 500 rupees. Okay. So now at 8,700 rupees, the person who has bought this from me, I have sold the call. Somebody has bought the call. He has a right to buy Nifty at 8,700 from me. Will he exercise the contract? Makes no sense because the intrinsic value is 0. So intrinsic value is 0. Okay. At 8,000 on 30th April, if Nifty is at 8,000, then basically, is there any intrinsic value to this particular call?
No.
Correct. The intrinsic value is again 0. At 9,500, what is the intrinsic value? So strike minus spot.
800.
Correct. So here the premium received is 500. So it becomes my full profit. Here it becomes my full profit. Here I have received 500 rupees. Okay. Somebody was saying something? Okay. So I've received 500 rupees and the intrinsic value is 800. So my loss is 300 rupees.
I'm so sorry. I just want to check from where this 800 came.
9,500 is where Nifty is, let's say on 30th April.
Okay.
And 8,700 is the call option which I've sold. 8,700.
Okay.
So 9,500 minus 8,700.
Right, 800. Yes.
Yeah. So
Yeah.
So 9,500 is the spot on expiry. And like I said, to find the intrinsic value, we have to do spot minus strike. Okay. So intrinsic value is spot minus strike. And these over here are the various spot prices. So at 8,700 or 8,000 or 9,500, whatever. So if these are my spot prices, the intrinsic value is 0, 0, and 800. And the premium I've received in all the three cases is 500, 500, 500. So if the market is going down from 8,700 or downwards, then I have basically made this 500 rupees. If the market is going up, then then I could lose money. But even then, not in all cases. So let's say let's make this 9,000. So what is the intrinsic value over here now?
300.
Correct. So even though the market has gone up by 300, because the premium I have received is 500, I would still make plus 200 rupees. Making sense? Let's understand this from scratch once again, because this is the most important aspect of how to understand option strategies. Option
Yes, please.
strategies will be nothing but a multiple of such legs. each of these legs will result into some profit and loss. You are entering multiple legs simultaneously which are contra to each other, where you know one particular leg will make money and the other will lose money, and you're doing that on purpose because you at the end want some little amount of profit and alpha to come out of the strategy. So each leg, finally the profit and loss will be calculated in this way. So understanding this concept will really help you take your understanding of options really far. So we will go through this once again. 8,700 is the call strike, okay? And I want to find out on 30th April if the spot is at 8,700 or 9,000 or 9,500, how would my profit and loss look like? So the first item would be to find out what is the intrinsic value of this particular contract which has expired. Means, do I even have to exercise that or not? Will the person exercise that or not? So at 8,700, nobody is going to exercise because the intrinsic value is 0. 8,700 minus 8,700, 0. 9,000 minus 8,700 is an intrinsic value of 300. And 9,500 minus 8,700 is 800. Okay. So the premium received is the same in all cases. So then the profit and loss calculation is pretty easy. Means whatever is the intrinsic value, this is in case of shorting the option specifically. Longing the option, the payoff would be a little different. So profit and loss is 500 in this case. Here the premium received is 500 and the intrinsic value is 300, and hence I have made a profit of 200. Here premium received is 500, intrinsic is 800, and hence I've made a loss of 300. So this kind of brings us to a question like, then what is the break-even point? At what point will I not make any money and not lose any money? And there, anybody knows the answer? It's actually pretty simple. So, given this, when will this become 0? When this intrinsic value becomes 500, right? When will this intrinsic value become 500?
9,200. At 9,200.
Correct. So at 9,200, my intrinsic value is also 500. The premium received is 500, and hence my profit and loss is 0. So that becomes my break-even point. We can do this exercise for puts as well.
So to sum this up, let's say I sell a call option of 8,700 at 500 rupees. So I'm buffered up to 9,200.
Absolutely.
Even if the market goes up to 9,200, I will not lose any money.
Absolutely.
Once it crosses 9,200, I'll start losing that much money.
Absolutely.
That is what it is. Right? As long as it stays below 9,200, I'll make some money at least.
Correct.
Correct. And if it stays 8,700 or lower, I'll get the entire premium that I had received.
Correct. Absolutely.
Yeah.
So if you are mildly bearish or you think that, it's going to be in this range, then it is smarter to, let's say, short a call because the buffer is so good. But let's say you are like really bearish, boss, this Corona situation is going to be like a day, it's like end days. So you would rather than buy a put, because there you're paying a premium of 200-300 or whatever. But let's say the market goes down by 2,000 points. So there you have a potential to earn like 1,700, so 2,000 minus the 300 premium which you paid, as compared to the maximum profit of 500 you'll pay over here. Profit you'll make over here. So that is another way, to determine whether I should short a option or whether I should long an option. So shorting a call or buying a put, both are bearish positions. But if I'm like very bearish, I would rather go for longing a put. And if I'm like mildly bearish, then I would rather, short a call. Do you want to do this exercise for puts as well? We can do that.
Yes.
Cool. So let's see the price of, let's take some OTM put. Okay, 8,300 put at 230. 8,300 put, 30th expiry, 230 rupees. Okay. So now I'm shorting the. You want to buy the put or short the put?
Sell the put. Short the put.
Sell the put?
Yeah.
Okay. So I have earned 230 rupees. Cool. So now on 30th April, the spot prices, let this remain the same only.
So basically selling a put would mean what? Am I long the market or short the market?
Let's go back to this. Short of put. I am bullish if I'm shorting a put. I will make money if spot goes up. I have received the
Perfect.
premium.
Got it. Perfect.
So, between because we are used to just long and short of futures and we know, okay, we are bullish or bearish. It was easy when there were 2 items. Now there are 4 items. There's buying and selling of a call and buying and selling of a put. So let's forget the short part. Short we will always consider as the reverse. It's like a easy thing which I kind of like a cheat sheet. So you think of only calls and puts in terms of buying. So if you're buying a call, you're bullish. If you're buying a put, you're bearish. So always start with that. Take that one extra step to figure out, if you're shorting, what your position, what's your view on the market. So if you're buying a call, you're long. So immediately, if you're shorting a call, you're bearish. It's exactly the opposite. So if you're buying a put, you're bearish. So if you're shorting a put, you're bullish. So you're taking that one extra detour, but then it's very easy to determine because you know that buying a call is definitely bullish and buying a put is definitely bearish. Means that's easy, right?
Yep.
So let's say one is 8,000. Let's keep these same strikes. So if 8,000, if Nifty is at 8,000 and 8,300 is the put, what is the intrinsic value of this put? Hmm? In case of put, it will be ulta, strike minus spot.
300.
So what is the strike? 8,300. What is the spot? 8,000. Intrinsic value is 300.
300.
300.
9,200. Strike is 8,300 minus 9,200. It comes to negative. So intrinsic value will become
Negative 900.
no. Sorry. Strike is 9,200 minus 8,300. So 900.
900.
And 9,500 minus 8,300 will become 1,200. Okay.
So the first one is minus 300, no?
No, I'm making a mistake here. Hold on. So the no. It is basically, we can stick to this one, top minus, right? 8,300 minus 9,200 means if the market has gone up, it's gone to 9,200. My 8,300 put is going to be out of money only. It won't have any intrinsic value like it doesn't have now. So all of these are out of money, right? These are all out of money. They don't have any intrinsic value. These, on the other hand, which are shown in yellow, are all in the money. So here intrinsic is 0. Here intrinsic is 0. Okay. I have received 230 rupees here. I have received 230 here. I have received 230 here. So here my loss is minus 70. Here my profit is 230. Here my profit is 230. And again, let's calculate the break even. So 8,300 minus 230. So this would become 8070. At 8070, let's see what happens. 8070. So the intrinsic value would be 230. Premium received would be 230, and hence my profit and loss would be 0.
Cool.
So this is what it is trying to say is, so let's say now you've shorted 7,000 put.
Yes.
Right? And you have received, let's say, 150 premium. So simple calculation was 7,000 minus 150. So 6,850 would become your break even. So similarly over here, 8,300 is the strike which I have sold the put at, and 230 I have received. 8,300 minus 230 is 8070. So we've come to the same conclusion.
Perfect.
This is just like a theoretical way of, there are a lot of these, cheat sheets or like, back of hand calculations, which we can go through once, the concepts are clear, the put call parity and seeing the time value of calls and puts. But let's first get a good idea of the basic concepts. So what else should I cover? Ask me questions, guys.
Umesh, at the end of the session, can you share the sheet that you're making, please?
Yeah, of course. Should I share it now only in the chat? Hold on. But this is such a bad sheet, man. But okay, maybe reference ke liye theek tha. So lesson 1. इधर कहाँ है फाइल भेजने का? Is there a way to share a file? ये साइन क्यों बोल रहा है यार? हाँ, okay. Chat file इधर है भाई. Let's see, यहाँ पे शेयर कर सकते हैं क्या? Okay, lesson 1. Pages नहीं होगा ना सबके पास. I have to save this as a PDF. इस पे डालूं. Guys, give me a second. I'm creating a link. I'll share it in the chat. I'm unable to upload a file in the chat. Everybody got the link in the chat?
Now I think no link is yet.
क्या कर रहा है to everyone? Okay, got it. मैं chat तो पढ़ा नहीं अब तक इसका. Once you understood, great, good, yes. Gone as a bouncer. Sanjeev Ranglani. Please repeat IV, which shows how volatile the market will be in the future. Sorry, when you're shorting, the long call and short put is the same. Okay, I was going a little too fast for novices is the feedback I've got. Okay, cool. Guys, what else? What other questions? Tomorrow, what all we can cover? ये था ना plan. Books also, I have actually plenty of option books which I can share, like high probability trading strategies. I was just going through option trader handbook, but these are like extremely complex. I can share it with whoever wants it. Just send me an email and I can give all these PDFs. I have like so many books that it will take you like 2-3 Corona lockdowns to finish. Yeah, but we covered option chain, strike, we covered expiry, intrinsic value, time value. This was the plan for the day. Tomorrow we'll go through option Greeks using the option calculator and then effects of all the Greeks on the prices and how like time till expiry and theta and all of that, they affect the option prices. Day after we can go through all the option strategies. So like having multiple legs and creating a strategy and seeing the payoff chart of that. And day 4, then we can go into algo trading and using Tradetron to create a strategy and deploy a strategy. So I know it's a little fast. It's kind of like a crash course. Means generally people take like a full 2-3 months to finish all of this. But yeah, you at least get an idea of the jargon and, whatever you read. So, from this point onwards, it will at least fit some part of the jigsaw. Means I'm the larger picture, I'm covering pretty much everything. So, whatever little bit you will learn independently now, you can at least fit the jigsaw, with your independent piece of knowledge. And at any point, you can just call me wherever you're confused and I can help you. I'll unmute all. Now everybody is unmuted. Whoever wants to talk can talk. Session is kind of over.
Thanks, Umesh. Still, I got a lot of it. Towards the end, a few things still went over my head.
Okay.
But I've come out more educated than when I came in, so I think that's a plus.
Stick to it. Stick to it. Maybe I'll slow down a little bit. Maybe tomorrow it's kind of all assimilate together.
Hello.
Yeah, I think once
Oh,
once we go through that sheet what you sent, and then also maybe prepare some more questions, maybe in terms of looking at it via maybe a stock as associating with it with an index. Sometimes
Yeah,
even that
we
can make it easier to understand when you look at those numbers.
absolutely. We can go through Reliance option chain tomorrow and create a strategy on that. Or even like if somebody's comfortable with the US market, we can do it with Tesla.
Yeah,
Or
maybe
all of
something like a Tesla or Apple or what, because most
yeah,
people
yeah,
do follow that, as a stock as compared to an index.
yeah, yeah. You
So that
learn
might
the
be easier to relate to, also with a name in place. Like, okay, what when you go with this option of this, the eventual outcome is you are expecting the market to go up and you want unlimited profit. So this is
right,
what it is
right,
versus the other way. I think
right.
probably if we
Yeah,
just simplify it in that sense to basics, then it'll be easier to pinpoint that this is a strategy, this is the outcome that's going to go if you go down this route. This is the outcome you're looking for if you go down. So then at least, we'll know which direction we are
yeah, yeah. Certainly,
heading down.
familiarity with the underlying definitely helps you understand the topic better. No doubt
Yeah.
about that. Like that.
Yeah. No, but good. Thanks.
No, man, it's all good. So we are good to go. Anything else,
All
guys?
right.
Yeah, yeah.
Otherwise,
Yes.
Thanks. Good session. Thanks.
Thank you.
thanks, guys.
Bye, buddy.
Bye.
Hello.
Okay. Bye.
Yeah, somebody
Hello.
wants to.
Yeah,
Yeah, go ahead.
just wanted to see, basically I'm not from the market. I'm just trying to learn from some tweets or some information which I'm gaining from the Economics Times somewhere.
Mm-hmm.
If possible, we can if we can open some site like Zerodha or 5 Paisa. From there we can show that this is how exactly it is happening, because any which ways we are doing it after market hours. From there we can show lively that this is how exactly you are doing. So it will, I think it will add more towards the what exactly it looks like. For example, short selling, I have heard, maybe I have heard today, first time. So
Okay.
I forgot what is the meaning of shorting, but shorting is selling, I think. So
Right.
I was not aware that shorting option is also available, which I was not aware about. So
Okay.
if I would have seen it in site like Zerodha or somewhere, it would have more related to me. And the thing which like there are some values like time value, interesting. These are the words which I heard first time. So it
Okay.
was little confusing initially. So that's what I was. I felt like if there was some kind of example live, I would have connected more. That is the only thing.
Okay. Okay.
That's my
Cool.
feedback,
I
nothing.
I have a brokerage account with Zerodha and Fires. I can show you that terminal and show you how the instrument looks like and how to go about executing this
Like for
contract.
example, we can put the value, and this is how exactly it shows what is the value it is right now, and from there exactly this is the rate is coming. Maybe that like likewise.
You want to see it now? I'll show it to you. Can you see my
That
screen?
would be great. Yeah, that would be great actually. Yeah.
Cool. Hold on. Zerodha. Right. Log in. You can see my Zerodha screen.
Yeah, I can see.
Okay. What was my username?
Hello.
Yeah.
It's not visible, sir.
Come again? Can't hear you.
The screen is not visible.
Okay, let me share it once again then.
It is visible actually. I think he has to click somewhere.
I'll do a new share of the desktop or let me do this share. Now, can you see Zerodha?
Yeah, screen is visible.
Okay, great. So this is the Zerodha account, and you want to search for any instrument. Let's say, what were we talking about? Nifty 8,800 call, let's say, right?
Malaysia.
Right. Yeah.
Malaysia.
Okay.
Malaysia.
I have to mute. Whoever wants to talk, please unmute themselves. Okay. So if I want to, so this is the Nifty 8,800 call, and as we can see, you know,
I don't know that.
Alexa, 8,800 call is 474.9.
I'm not sure about that.
And if you want to buy this, you click here, and how much of a quantity you want to buy. And these are various other concepts in trading: limit order, stop loss limit, market order. So that's not a part of this particular thing, but I can help you all if you all don't understand this as well. So MIS is basically if it's an intraday, so intraday square off, and normal is if it's a positional trade where you are holding the particular position overnight. So the margin requirement changes from MIS to normal. So again, this is regular, this is bracket order, this is cover order, AMO, aftermarket order. This is like they will hold the order for you, and execute it whenever the price means, even the next day, basically. And this is immediate or cancel and date. So these are the various product types, but the basic contract is this, and you can either buy or sell them.
Right. The selling option I want to understand actually. Selling option. Selling options.
Yeah, so it's as simple as just sell this, right? Click on sell.
So what is the rate we are buying it? Like 470?
Yeah, you'll be 474.9 is the rate at which you'll be selling.
So here when the price goes down like 473, 471, then we are going to earn here in the selling option.
Correct. Anything which you have sold, and if it at 474, anytime the price goes down, you're making money, right? And if you are if you have bought something and the price goes up, then you make money.
Then you are making money. Right. Okay. And just one more thing, this AMO option in Zerodha, does it work very well? Does it work actually? Because I have tried, but I have never seen it is working.
I haven't tried
right
it.
Now. Yeah. Okay.
It changes from broker to broker. I wouldn't know.
Okay, so basically buy and sell both are same. Only thing that when you are aware that maybe you have some kind of concept that today market is going to fall, then you can go into sell, and then you can this is okay.
Absolutely correct.
Okay. Thank you very much.
Yeah, no problem. Okay then, so I'll see you guys tomorrow then, 4 o'clock. Let's cover Greeks. That's a little still more complex. We can have like the first 15-20 minutes refreshing what we did today. So ask all the questions, come up with scenarios, and we can go through that first, then jump into Greeks. I think 1.5 घंटा तो लग ही जाएगा. आज भी लग ही गया. So I'll see you all tomorrow then.
Umesh, link will be the same or different?
No, same link.
Okay. Thanks.
Yeah.
Bye. Thank you very much.